Welcome, everybody, to today's webinar, Betting on a Post-COVID Future. Our topic today is the state of the venture capital market, which is enjoying its biggest moment since the dot-com days of the 1990s. We'll consider the implications for lawyers and the legal industry. In particular, we'll be talking about a new venture capital report that's been published by Litera using data and insights from the financial data company Pitchbook. And because I know somebody's going to ask, you'll all get a copy of this report after the webinar. Everybody's registered will get access to the full report that we're going to be talking about here today. And before we begin, I also want to just point out our question and answer box. We will leave time at the end of the program for your questions and answers, but we like this to be something we like you to engage with us as we're going through it as well. So if you have a question about something we're talking about at any given point in the webinar, go ahead and drop it in the box. I will be monitoring that throughout the hour. And if you have a question that's pertinent to what we're talking about, I will be sure to highlight it for one of our panelists. So before we get started, let's start by introducing our panelists. And I'm going to ask each of them to introduce themselves and tell you all a little bit about themselves. So Sherry, let's start with you.
Hi. Thank you, Bob. I'm Sherry Capel. I am an evangelist here at Litera. I have been with actually so many of the different formations, been an employee at so many of the different formations of said, acquisitions and mergers, etc. It's very wonderful to have a discussion about this topic today and see what's going on behind the scenes. I have been involved in the technologies that deal with legal and legal documents for about 30 years.
Amazing. You started when you were in kindergarten. That's so impressive.
Only 7. Yes.
And Alex, introduce yourself.
Hi, everyone. Good morning or good afternoon. My name is Alex Licken. I'm a senior analyst at Pitchbook. I've been here collectively about 8 years now, and I cover venture capital, private equity, M&A for a variety of institutional clients. We are up in Seattle, and it's a little early, probably earlier for us than it is for everyone else on this, but very happy to be here.
Great to have you, Alex. And I am Bob Ambrogi. I will be moderating today. I write a blog called Law Sites where I cover legal technology, and I also write for Above the Law. Above the Law is producing today's webinar. Litera is sponsoring it. And as I say, we're going to be talking about a new report that's just been put out by Litera on the VC. And Alex and Pitchbook have been instrumental in preparing and writing that report and analyzing the data and pulling together the data. So the format today is going to be that we're going to hear some presentations from Alex about specific aspects of the data, and then Sherry and I as well will offer some comment sites from our own perspectives on what Alex is presenting. And again, as I just want to reiterate that at any point, if you have questions, you in the audience, go ahead and drop them in the box, and we'll put them to our panel of experts here. But Alex, you want to just start by telling us, kind of giving us an overview of what this report covers and what kind of data you're looking at here?
This covers everything. The numbers are on a global basis, so they're a little bit different than some of the U.S. numbers that are commonly cited, but we take a look at VC deal activity itself. We take a look at VC exit activity, which popped quite a bit. We cover valuations, and then we also look at the profiles of the investors who came in 2021. In my opinion, that is one of the more interesting aspects of the last 2 years is the number of non-traditional investors. I mean, the trend goes back quite a ways, but it was really emphasized in 2021 where you had hedge funds and private equity shops corporate venture capital and the like pouring into the venture market and specifically the late stage venture market. So it's broken down by a number of metrics. And I think the first slide that we're going to cover is just an across the board record, and things get more interesting from there.
All right. Well, let me bring up that first slide. And it's been quite a year, 2021. Why don't you tell us about it?
There's a whole lot to say about it, but I'll leave it at this, that, for the first time, 600 billion, and this is through late November due to a scheduling issue. That was the latest that we can get out. But what's interesting in that 2021 number is that all 4 quarters were above $100 billion in venture capital invested. It's only happened 5 times reaching that threshold, and the 5th time was the 4th quarter of 2020. So we've had 5 straight quarters.
5 times ever, right? 5 times ever.
5 times ever. Yeah. That on a global basis, 5 straight quarters of $100 billion or more. Part of it was due to pent-up demand. If you go back to the spring and summer of 2020, a lot of venture investors were a bit handcuffed. No one knew exactly what was going to happen, and also on the side, they had their own existing portfolio companies to take care of. So there was quite a pause for a good part of 2020, but as the latter half of 2020 rolled around, you really saw this momentum start to build, and it just kept on going throughout 2021. Late stage activity was the primary driver, particularly at the Series D and later stages. One trend that didn't make it into this report, but I've noticed it in a number of sectors, is that there was a prevalence of, you might call it double dipping, where startups were raising 2 rounds within the same year, and sometimes they're significant rounds. There was also a number of companies that raised in both 2020 and 2021. So there was quite a bit of familiarity in the market, you can say. When we wrote this report, there was a whole lot of optimism. Things have changed a bit in the past couple of months due to geopolitical and macro reasons. But when we put this report together, the venture industry was looking at an inflection point of sorts. Across dozens of markets, you had investors and startups sort of reimagining what their companies can do and what their industries might look like in a post-COVID world. What's interesting is whether all that momentum can sustain itself with new headwinds. For example, this just happened last week that Instacart voluntarily cut its valuation by almost 40% following a chill in the tech market. They didn't have to do that, but they thought that it was a prudent thing to do. So what could happen in the next handful of months is that you could see other startups, agree that might be the prudent thing to do as well. I know that we're going to get to valuations in the next slide, and you'll see how much that they've popped. I think the question is whether or not, some of these valuations might be a little bit overblown.
Yeah. When you talk about the impact of geopolitical forces, I mean, I assume you're primarily talking about the Russian invasion of Ukraine. So we don't know what the impact of that is going to be kind of going forward. But what do you think was it that sort of created this momentum in the first place? To what extent, perhaps, was the pandemic a factor in driving this momentum in 2021?
Well, I think, people were interacting with each other in different ways. People were doing different things. I mean, you had, e-commerce took off. Telemedicine took off. All these technologies were existing, but they weren't being put to use a whole lot, say for e-commerce. But, following COVID, people were, forced to change some of their habits and some of their activities. And so I think that you had across consumer services, legal, certainly, finance, healthcare, you had so many issues coming up at the very same time that, I think venture investors got excited about that. It's an inflection point in the sense that what are things going to look like a year or two from now? And the fact that no one really knew the answers, at least in 2020, meant that there is an opportunity to reimagine and reconfigure some of these markets. And also, I think the underlying technology just continues to get stronger and stronger. I've put forward this what if that pandemics can come at any time. What if this one happened in 1998 instead of 2020? I think that American society was able to handle this a lot better than it would have been able to do 20 years ago. And a lot of that is due to really strong underlying technology across all kinds of markets. So I think investors recognize that, and they continue to recognize that. It would be a shame if we have an opportunity to innovate as much as we can right now and have that stymied by not only the invasion of Ukraine, but also inflation, public tech markets, hitting a curb. There's all kinds of reasons why this can slow down, and it would be a shame if it did.
Sherry, what are your impressions from this slide? I mean, as Alex points out, where would we have been probably without some of the innovation that already occurred as we came into the pandemic, or where would we have been without Zoom? But when you look at the activity that happened in 2021, what are your thoughts on that?
I think, I'm going to take it from a couple of perspectives, but one of them is if you all consider just achieving work, achieving collaboration, achieving documents, just doing legal work. If you didn't have these technologies, everything would have stopped, right? And even though I believe that there was so much aversion to it, it was astonishing to me how quickly people picked it up, used it, saw it as an absolutely essential tool, and immediately. And so I feel like it was such an unleashing of experience, things that people didn't first think about, right? They didn't first think about using these kinds of collaboration tools. As a matter of fact, they kind of ran the other direction. They wanted to do it all in person. And how that unleashed things once it was a requirement. It's a really fascinating view. I also think that there's been a lot of investment in making things easier. It's almost like we had this, from the technology point of view, we had this opportunity of maybe it was like a whole decade of being able to make things easier, more intuitive, more accessible. We worked really hard at it for what felt like no necessary gain, right, in the end. But then this hit, and all of a sudden, every investment from that point of view, it truly took off. I also think about the fact that technology is always driven by business. Always. It supports a business. And so the agility, Bob, that's the thing. On the tech side, the agility that everyone attained in this was something, honestly, I agree with you, Alex. I wouldn't want from the technology side for any of this to stop either, because it's just made such strides after so many years of feeling like we were kind of making, just treading water, so to speak. We weren't really getting anywhere. So that's kind of my take. And then with that activity elevating, we had more business to support. And the fact that we could scale and achieve supporting that, all of that is, to me, it's marvelous, really.
Yeah, obviously a market I follow closely is the legal technology market, and I know this report doesn't specifically break out that vertical, but I know, Alex, you talked about sort of the extent to which COVID-19 brought about these inflection points in various vertical markets. Do you have any sense or perspective on whether the legal technology market is one of those? I mean, it certainly seems to me that legal tech has been an inflection point for the legal tech market, and that it dramatically changed interest in the market, activity in the market, and even it drove innovation in the market. But Sherry or Alex, do you have thoughts on that?
I'll offer some quick thoughts and offer it back to Sherry. But there were still deals getting done in the nadir of COVID, and social distancing requirements required that people do everything online. And there was some speculation, including on my part, that would be a hindrance to deal activity. That the trust factor within the venture and within all finance, looking people in the eye, having dinner, building trust was going to be hurt by doing everything online. But everything that I've heard is that migrating everything over to Zoom and to data rooms and probably to legal tech, a lot of applications in legal tech as well, actually helped in some ways. Everything was right at your fingertips. And so, I think just the social distancing elements and the fact that people were forced to do this online and find tools that were going to not replicate, but actually replace person-to-person interaction. And it went swimmingly from everything that I can see. So, I think that the legal tech sector and a number of other sectors, stepped up and they put tools out and they got used to it and life went on.
Yeah. Sherry, anything to add to that?
Yeah, Alex, it's so interesting. I think the online, the distance that people feel or perceived of online communication, the reality is that any kind of online presence or medium or media for any of that, it either amplifies the distrust or it amplifies the trust, it amplifies the message. And all of those things are things that people didn't quite realize. I'm not sure that everyone wanted to be a television broadcaster, but we all became that. And so there's a lot of dimensions to it, but in many ways it just compacted it all and accelerated it all. There was a lot that was distraction, and it focuses people. So I think for all those reasons, we were all of us able to achieve greater strides in the and deliver against it than we had in the decade before, for sure. For sure.
It is interesting how it focused us in ways we would never have anticipated. I think, especially when it was first starting. But it's been. There'll be a lot of books written about the last couple of years.
There will indeed, and movies. I predict a few movies too.
Yeah. Well, let's move on to the next slide and talk about valuations a little bit. Alex, I know you want to talk about this a little bit.
Yeah, and it jumps off the page, right? The late stage jump to $84.3 million. That's a median, which is roughly double what it was in 2020. And even when you're looking at 2020, it actually inched up a little bit, even in product market. So, you'll notice in this slide, particularly at the early stage and the late stage, that things tend to generally go up, but not to this extent. So you had late stage markups doubling. You had early stage, which roughly is Series A and Series B, the median valuation jumping from an $18 million pre-money valuation to a $33 million valuation. And even on the angel and seed side, you had $5.5 million up to $7 million valuations in 2021. So up across the board. But the increase at the late stage is is rather striking. And, going back to the point about Instacart, there are a number of companies that are going to succeed. And, one of the things 2020 and 2021 brought about was fairly easy, an easier identification of winners in certain markets. And so when you identify a winner that is going to either go public or is going to be attractive to a big corporate, it's a little bit easier to stretch those valuations. The question is whether not all of them are going to be winners. So for the companies that aren't going to, I think one question is, did they overreach on their valuation, and is that going to hinder them going forward? But, I do think that there is something to be said just for how big of a difference this is in 2021. I think that this chart says a lot.
And I think one of your findings was, and I guess you alluded to this, but was that even these sort of pre-money valuations were at a historic level. What does that tell us about the market, or about how VCs are approaching the market?
Well, I think there was a lot of optimism before COVID. Some of this comes back to the fact that there have been a lot of successful exits over the past 4 to 5 years, and that certainly bolsters optimism in the overall venture market. I do think, though, that COVID, really, it was an important. It's really one of the most important factors when looking at these valuation jumps, because you're going back and you're potentially reinventing a market, and so there is going to be a lot of hype, and so that certainly plays a role. But the optimism that we have now, it's been around for 5-6 years. It just really hit the goal in 2021.
Yeah. Well, other than for VCs and for the companies the VCs are investing in, why do valuations matter? I mean, why should people listening to this, what should they take away from the fact that valuations are up? What does it signify?
It's a good question. I think that it signifies optimism. When you put a number on a company, you're trying to look ahead, right? Finance is a form of time travel. That's one of my favorite sayings. That if you are confident enough that a particular company is going to succeed, then it's a little bit easier to put a higher markup on it. Some of it also is a give and take between the startups and the investors. So when you have a founder-friendly market, like I would argue that we have right now, then it's a little bit easier to raise money and then also throw your weight around and ask for a higher valuation. The other point of it here, especially at the late stage, is that so much of this was driven by non-traditional VC investors. They're not even really VC investors; they're hedge funds, they're private equity shops, they're mutual funds, and they don't care about valuations. I mean, they do a little bit, but not to the degree that early stage and traditional venture investors do. In a lot of cases, they're just trying to get a 5-6% stake in a company before it goes public, and whatever the founder asks for a valuation, there's going to be, you're going to be pushing an open door with a lot of late stage investors like hedge funds, and they're going to, give you the valuation that they want in exchange for getting the stake that they want. So there is a lot of that baked into this chart as well.
Yeah. Sherry, do you have any thoughts on this or observations on this?
Couldn't find the unmute. I guess one of the things to go back to, Alex, is that this optimism you talk about, that started before the pandemic. Would you say that it has increased the optimism? So say in 2023, as an example, are we still going to be optimistic, or are we going to be a little more conservative?
It's a very good question. Not all these companies are going to win, quote unquote. I don't want to draw comparisons to the dot-com era, because I don't think that we're living through a redux of the dot-com era. But there was There were stretched valuations 20 years ago because of this sense that the internet was going to change everything rapidly within like the next 2 or 3 years. There is also this sense of COVID and post-COVID changing everything rapidly within the next 2 or 3 years. So I think that there are some parallels, which makes me a little bit, nervous seeing some of these charts that we might be getting a little bit too far ahead and we might be a little bit presumptive. A lot of these companies seem promising now, and the reality in startup world is that a very high percentage of these companies will not succeed. So you do have to temper it a little bit with history, but the optimism is well grounded because the technology is well grounded. And again, it's a very general overarching point because we're talking about lots and lots of different markets and lots of different technologies. But almost no matter who you talk to in the industry and what sector they cover, they're almost saying the same thing sometimes. Like this is so promising, XYZ is so promising, or this technology is really going to make a breakthrough here pretty soon, and we're proving it. So, the optimism is widespread, and I think it's because the technology is so sound.
So to that end, you mentioned earlier about innovation, and I just would love to hear a little bit more on your take on that, because again, from where those of us who are in the tech side, right, what we're seeing so much of is the puzzle pieces coming together from interesting directions. And I hesitate calling it a mashup of technologies, but how when they're all put together as a kind of platform, or they're put together as a cohesive set of tools for any sector. I think the innovation is in some ways just the creative thinking of that, but I'm curious your take.
Yeah, I'm working on a project right now on the gaming industry, video games. And, a lot of it is in the venture realm. But one person I talked to actually made a very interesting point that NASA, the space program, has long been a source of almost accidental innovation, where things that are designed for the space program end up getting repurposed in some way. And the gaming industry, there are some parallels to that in the gaming industry, and you wouldn't necessarily think it, but virtual reality, for example, is making big strides as a technology. And right now, a lot of it is being put to use in the gaming industry, recreational entertainment. There's a lot of money in that industry, but virtual reality has lots of other different uses, pilot training, surgeon training, things like that. And so, that's just one example, but I think it is indicative of not only the strength of the underlying technology across all kinds of markets, but also its alternate uses. So I would point, gaming comes top of mind, and I, had never really looked at it that way before, but a lot of people who are involved in the gaming industry are excited about that as well.
I think we're all eager for innovation and all the interesting places it comes from. So awesome. Bob?
Would we have Tang if not for NASA? That's the question. One of the great innovations. Yeah. So let's. Why don't we move on to the next slide? Because one of the trends that you've identified here is the extent to which VC activity has been kind of reshaped by the way investment is happening. So, Alex, you want to talk about that?
Yeah. So when we first looked at the numbers, I put together a sort of a baseline increase. So the overall percentage of capital invested increased by, I think, 76, 77%, somewhere around there. So that was sort of our very rough baseline. When you looked at cross-border VC investment, it was just as high, and it's, you can clearly see in the chart, it's a lot higher than normal. So last year, almost $123 billion was invested across borders, which was 73% higher than the previous record in 2019. Interestingly, there were similar trends just here at home in the United States. A different project that I worked on, we looked at the number of coastal investors who were investing outside of Silicon Valley and outside of New York City. And what happened was that under COVID, Silicon Valley, New York, they not only invested in nearby ecosystems like Los Angeles or Boston or Philadelphia, they went inland. So they went into places like Nashville, they went into Denver, they went into Dallas, Raleigh, Charlotte, all kinds of places. And so you had this migration over Zoom because, it's almost like what difference does it make if you can't have a one-on-one in person? And I think that there was an epiphany on the part of a lot of VCs that there are a lot of good companies out there. And just because they're in a different state or in a different country, all of a sudden that part of it wasn't nearly as important because everything is being done over Zoom anyway. And it's interesting because venture is often thought of in localized terms. The rule of thumb is that VCs want to be within a 20 or 30-minute drive of each of their portfolio companies in case something goes wrong. COVID threw all that out the window. And I think that the industry itself has gotten really acclimated to investing over Zoom, online. Whether that changes at all as society opens up, I think there's going to be a bit of a hybrid structure. And it's going to be a new tool for the venture industry going forward that you can do these things over Zoom. Even when one-on-one interactions come back, I think that this is a signal of some kind of new normal for the venture industry itself.
Yeah, I thought this was really one of the more interesting parts of this report, just because it's not something I had necessarily thought a lot about before. The idea that VCs tend to invest, as the report suggests, more on a geographically local basis, and that the current environment has changed that. Sherry, what are your thoughts on that?
I was surprised as well. I always had an impression that everything was global and was always looked at that way. But then again, I realize now that when what you have is that real estate, that place, that chair in an office on the whatever floor, you probably do keep things closer. And your cadence for meeting with people and for interacting with people and so forth, it doesn't occur to you that isn't a global reach. So this was fascinating to me. And again, I feel as if that, Bob, is what's driving innovation, is just having the diversity of thought and having the diversity of literally everything, cultures and people and, these mashups being fueled in this manner. I feel like it is driving so much of the acceleration. Because otherwise these things weren't attainable, can't drive down to, another country across a pond.
Right. And not only diversity, since you raised diversity, it made me wonder whether this is also driving investment in more diverse startups in terms of minority-owned or women-owned companies. Alex, does the data tell us anything about that? Do we know whether there's greater investment in diverse companies?
Okay, I'm off mute. I also put together Pitchbook's All-In report, which is based on female founders in the United States. And no, the numbers were pretty stagnant. The absolute numbers went up across the board, and that was certainly the case with female founders as well. But when you look at the ratio, it's pretty much stuck where it's always been. So, there's a potential for that kind of thing, but we're not seeing it in the data quite yet.
Well, that's depressing.
Yeah, couldn't have said it better myself. Oh my goodness.
Well, it has been interesting because I tend to be focused in the legal tech world, and we don't have a lot of data on that, but there is a woman, Kristen Sunday, who works, the founder of Paladin, who puts together a diversity report every so often on founders, on diverse founders in legal tech. And the last time she did it, which was, I think, now probably 6 months ago or so, it was pretty much the same. It did not find actually much gains in terms of diversity of women or people of color in founding companies, and yet certainly in the legal tech market, from what you just visually see, it feels like this industry has gotten a whole lot more diverse than it was just a few years ago. So I don't know, Sherry, what do you think? Any thoughts on that? Or
I simply hope that it's at the beginning of its long overdue acceleration. That's what I hope. That's not to say that it's any kind of a prediction. It's just more, we have to make things like that more visible. We have to be very intentional about it. And until those things happen, it's a sad set of numbers. That's for sure.
Yeah.
Very sad set of numbers.
All right. Any other thoughts on this investing over Zoom topic before we move on to what's going to be our final slide here?
Yeah, I wanted to, in my opinion, this was interesting that it sort of blends the international cross-border aspect of it and also the non-traditional aspect of it. When you looked at certain rounds that were raised last year, there was one for Flipkart, which is based in India, raised a $3.6 billion round in July of 2021. That money came from 3 sovereign wealth funds, a Canadian pension plan, SoftBank, Tencent out in China, Walmart, and the hedge fund Tiger Global Management. Then I also found this company called Northvolt. It's based out of Sweden, and it makes lithium-ion batteries. It raised a $2.75 billion Series E in June, and that was led by 4 Swedish pension funds, Goldman Sachs, Volkswagen, IKEA, and a Canadian pension plan. So there are so many examples of that going around right now that a lot of these late stage rounds, you don't even really see any traditional venture investors. It's all these big guys coming in. And what was fascinating is that there's so much cross-cultural blending from Europe, from certain countries in Asia and North America. The one exception to all this was China. China invests in its own companies. And you often have state-owned banks and state-owned entities that are fueling like these very massive rounds in China, and they are the exception to the rule. Everyone else is enjoying big money from pension funds, from insurance companies, from mutual funds, from corporates. Everyone is getting into the game. And that sort of earns the moniker of tourist capital. And tourist capital can be, finicky. And the first sign that something is amiss, everyone just kind of leaves all of a sudden. So it's something to keep an eye on. If you see big non-traditional investors all of a sudden slowing down their pace, then that might be a chill in itself. Interesting.
And that kind of relates to the last slide that you prepared here on exit Bonanza in 2021. You want to tell us about this slide?
Sure. There it is. So you'll see, again, all 2021 charts, they all look like skyscrapers compared to previous years. Perhaps none more so than exit activity. It went up to $1.2 trillion globally, which is, needless to say, the first time it's broken the $1 trillion mark. It hadn't even crossed the $500 billion mark before 2021, so went well above historical norms. And for the first time globally, you saw more than 3,000 VC exits. Some of the reasons venture capital primarily has 2 off-ramps. You can go public or you can be acquired. 2021 and 2020 to an extent, were very, very accommodative exit markets. So you had a wide open IPO window for VC startups, and venture investors were taking advantage of that, and startups were taking advantage of that. The last webinar that we did, Bob, we talked about the M&A side of it, and that applies just as much to venture exits, where you had all these companies scrambling and trying to figure out, okay, so if our industry is going to look a little bit different over the next 2 or 3 years, how are we going to change ourselves? Are we going to develop new technologies? Are we going to develop new solutions to everything that's going on? Or can we just buy it? And you saw a lot of buying in the market last year. So that same factor, rethinking business models due to COVID had a big impact on VC exit activity. This $1.2 trillion is going to go back to LPs, and LPs are probably going to reinvest it. So you can take a look at these exit numbers and get a sense of how future fundraising statistics are going to look. But we've never seen a number like this before, $1 trillion exited.
And one of the interesting points you made in the report is this idea of private equity firms as exit routes for companies, and the idea that there seems to be an uptick in private equity firms buying innovative companies in order to, as you put it in the report, I think, bolt them onto other platforms that already exist. So for a bigger, more established company, it's a way to add innovation without having to develop the innovation internally. Mm-hmm. Is that something you think we're going to continue to see more of? Or?
We certainly could, yeah. Not only are VC add-ons, to coin a phrase, a sloppy phrase, but buyouts of startups themselves are actually going up. And historically, that has been just you don't even think about it, because startups in years past don't make money. Revenue doesn't come in. If you go back to the dot-com era, there were, I don't know how many IPOs where the companies were losing money and losing lots of it, but the promise was there. Startups today, particularly on the software side, are making a lot of money. A lot of industries, VC-backed industries, have figured out their revenue models. And it's taken a lot of time. It's taken 2 decades since the promise of the dot-com days for that to really swing into full motion. But that's one reason why you're seeing private equity shops come in right now, is that you can buy a venture-backed startup and there's a path to growth there. And a lot of private equity firms actually are, I don't know if they're better suited, but they're well capable of helping startups achieve really high growth. And also the stigma of private equity not really knowing what it's doing in the technology space has really gone away. You have firms like Vista Equity Management, who, and Thoma Bravo and Silver Lake and a number of others, where they are taken just as seriously as the biggest and most prominent venture capitalists in Silicon Valley when it comes to understanding technology. They can just do it on a bigger platform. So I do think that you're going to see this blend continue to happen. It will probably happen even more, especially if some of these buyouts become success stories. There are going to be other private equity shops that are going to say, we need to expand our view. It's another huge potential source of deal flow because there are so many companies coming out of Silicon Valley, Boston, and New York that are making money that these private equity firms can buy them and improve them significantly.
Yeah, this trend of larger, more established companies buying up other innovative companies is certainly something we've seen a lot of in the legal tech world. Sherry, not mentioning any names, but...
Not mentioning any names at all. In fact, as Alex was talking, Bob, I was thinking about this, that honestly, and again, my background is that I started with one of the origin companies when we had 4 people. And I had someone ask me, like, how is it that you can handle this now that there's so many more people at Litera? And I said, are you kidding me? I was there when there were 4 people. This is so much better. and honestly, what really it comes down to is the investment, the actual fuel that causes that engine to be able to run and achieve great things in accelerated amounts of time. And then again, at the core, as Alex said, it's just fundamental technology that makes things better. I guess I would really be interested, Alex, in your thoughts about how does all of this impact the law firms? How does all of this impact what they need to be preparing for? And my goodness, it's a whole different world, really, with so much activity.
I don't have the best perspective on that. I do know some people who are exhausted.
Yes.
And it's the same way on, lawyers working on M&A transactions, private equity deals, is that there's so much coming in that it's hard to even get a moment to catch your breath. I heard so many anecdotes of deals that were stalled in the pipeline because teams of lawyers, also investment bankers, they just didn't have time to get to it. And that there were also really good opportunities that they were passing up because they had even better opportunities in front of them. So, from what I understand with the legal field in an environment like this, is that you really have to go quick, and it may get a little bit overwhelming. I've heard that from a lot of people, particularly on the investment banking side. I used to work at Goldman Sachs. I'm still close to a lot of people there. That you're just sort of inundated with these things, and the technology needs to hold up. And from everything that I've heard, it has. So it'll be interesting to see if there are any new habits that are being formed, or new processes that stick around due to not only COVID and the technology and all that, but just the inundation of deal activity going on right now, that it might also tweak a few processes going forward. So,
that's
Sherry,
a
what
very
are
good
your
thing.
thoughts on it? Yeah.
I just think it's a very, very good thing because there have been so many manual processes that, heroic efforts to get things over the line. And in many ways, technology levels that playing field because there's just so much that can be repeated and so much that can be processed and so much volume that can actually create a process that actually is sustainable and repeatable. So it's about time is I guess what I want to say. I kind of wish, Bob, I was really at the beginning of my career because this is getting really exciting.
I'm not sure I could take it. It's just so it's so exciting and interesting right now. The report actually talks about the report that we've been talking about here today. Actually talks a little bit about this and actually interviews some lawyers about how this upsurge in VC activity has impacted the work that they do. There's a whole Q&A section in this report. And as I say, people in the audience, you'll get a copy of this. But for example, one lawyer's associate at Goodwin says, quote, "The pandemic forced the venture capital world to rethink due diligence with technology-driven solutions that brought incredible efficiencies to the process. With virtual data rooms, record digitization, Zoom meetings, and digital collaboration tools, the due diligence process can be done just as thoroughly as it was prior to 2020, but now with greater speed and at smaller cost." I mean, it kind of reminds me of where like the e-discovery world was a decade ago or something, that the whole way that we do, e-discovery used to be done with file boxes in warehouse rooms with armies of associates sitting there. And now it's all done by technology, and the due diligence world, the transaction world is really changing a lot too.
And it's interesting because the gentleman also spoke about Andrew Sparks, a partner at Goodwin. He spoke about the fact that it's the whole ecosystem, right? The whole venture capital ecosystem, from the investors and the startups to the law firms and other providers, is incredibly busy and recruiting heavily to take advantage of the abundant opportunities in the market today. So that recruiting thing we've also seen, right? We all have so many openings for people, so many.
Right.
If things are getting it from I'm no lawyer. I know lawyers. If things are getting done with greater speed and at a smaller cost, I wonder what that does for billable hours for them. So,
Shh.
it's top of mind for a lot of lawyers.
Yeah. No, I think any lawyer who decides they don't want to adopt innovative technology because it may reduce their ability to bill time is got a very misguided perspective on how they're serving their clients. Alex, there was actually a question from the audience on that slide 4 on the exit, or slide 5, I guess, on the exit bonanza, just asking if you know what was the average return for these in terms of the exit activity for VCs.
That's a good question. I don't know the answer off the top of my head, and I don't have it in my notes. I can probably get back to the person who asked that question now.
Okay. And people watching the webinar, if you have questions, this is your time to drop them in the Q&A box that you should see on the lower left-hand side of your screen, I believe it is. I'm seeing a different screen. That's why I say I believe. And we've got another 8 minutes or so here, 7 minutes or so here for the webinar. One of the things I wanted to point out in terms of the exit activity, also again in the legal tech world, that where my blinders always lead me, is that in 2021 we had, well, prior to 2021 there had not been an IPO in the legal tech world since 2002. And that was one of the few ever in the legal tech world. And then in 2021, there were 3 different legal tech companies that had IPOs. So a significant development. I mean, not a huge number compared to the market at large, but given that there hadn't been any in the legal tech world, at least in the U.S., there was one in Australia, I think, prior to this. But in the U.S. market, there were 3 IPOs in 2021 with LegalZoom, Intap, and Disco all having public offerings this year. So
a lot. One thing that happens in venture is that there is this, I guess you can use the phrase, proof of concept for an entire industry, where a single transaction, let's say in this case, LegalZoom, it goes public and it does well. That's a signal to the rest of the market that this type of company can succeed. This is in the ag tech market, agriculture technology. That market it's pretty quirky. It's really fascinating. But it wasn't until a $1 billion acquisition in 2011, I think it was, the Climate Corporation was acquired for $1 billion. And that just kind of came out of nowhere. And up until that point, there were much smaller exits. It was this niche little market that everyone kind of left alone. But then you see a $1 billion acquisition, everyone says the ag tech market could be significant. And from that moment on, ag tech became a much more prominent sector for venture, and you saw investment tick up over time. So sometimes it takes those, watershed moments for people to realize that, hey, it's a new market. It might be a little bit quirky, but it looks pretty profitable. So,
yeah, there was a question earlier on, back when you were talking about the video game industry, from somebody, and they actually asked, do you advise investing in video game studios? And I'm going to guess that you're going to tell us you're not an investment advisor. And
I am not an investment advisor. It's fascinating though, looking at that sector. It really is something. And again, COVID really locked people in their homes, and so video game usage went up. But at the same time, the demographics are pretty different. You have people in their 20s, 30s, and even 40s playing video games, buying the merchandise, and spending good money on this. And it's sort of become a social outlet for a lot of people. Whereas when I played video games, I had to quit cold turkey because I was too addicted to them when I was in in middle school and junior high. And I'm so glad that I quit because I see these video games now and they're just incredible. And I would be out of a job if I was as addicted as I was back then.
And then a related question was if virtual is seeing such great advances, why are a lot of people and experts do not believe in Meta, or why are people skeptical about Meta?
You'll have to ask them. Some of these concepts that are coming out of the blue, I think it'll take time for people to fully acclimate to them. Virtual reality, though, I think has very, very practical uses right off the bat. So, if you're training for dangerous situations, or if you're training, just to be a precision surgeon, the fact that you can incorporate virtual reality into your training and probably expedite it quite a bit. I think that it's a lot more obvious to people who are watching that technology develop how it can be put to use in real life right away. Things like Meta or Web3, I think, conceptually people are not, they're hesitant to wrap their minds around them. So I think there is a difference there.
Yeah. In the legal world, I wrote about a company earlier this year that is using VR training to provide courtroom training for lawyers who can't go into courtrooms because the courtrooms are all shut down.
Interesting.
So they're using VR to train lawyers on courtroom skills.
And Alex, I have one question that I want to come back to, and that is for female founders, for women who are launching startup companies. What sort of key advice would you give them to be successful in this, to raise those numbers we talked about earlier?
I just had a discussion a couple weeks ago with someone from JP Morgan and a woman named Katie Ray, who is the founding partner of the Engine. It's out of MIT. And, one thing that you can look at, specifically talking about Katie, is that she is the managing partner of the venture firm. She has check writing authority, and a number of other women at the Engine have check writing authority. When you have female check writers who can actually write those checks and make investment decisions, you tend to see a ripple effect. Because there have been studies done that suggest, and this is also anecdotally confirmed as well, that a lot of female founders feel more confident and more comfortable talking and soliciting from a female investor. And from the female investor's point of view, sometimes things may go over the head of a male investor, and they're not going to catch something, but the female investor will see it. You're really looking for potential, and is this person the right person to take this company to the next level? And when you have more female investors with check writing authority, I think that you'll see those numbers go up because it'll have a compounding impact on female founder activity at large.
I don't know that we ever broke this down. Yeah, I don't know if we ever broke this down much by verticals, but there was a question as to what your predictions are for the top 3 verticals in the year ahead.
Oh, God, if I was able to predict that,
Well, what have been the top 3 verticals in 2021, say?
I would think that fintech would be up there. Digital health. It's so hard to say because I think that you can make a case for at least 10 industries. But, these industries that were coming into their own prior to COVID and where COVID had an impact, things like fintech or digital health, telemedicine, those types of things, I think that you're going to see sustained growth for those types of industries going forward because their technology proved that it worked. Telemedicine is interesting because it was around for a long time, but neither doctors or patients trusted it. They didn't want to use it. Then they were forced to use it, and they said, oh, this is fantastic. So it's a very hard question, though. I don't know the precise answer.
Yeah. Sherry, any we're at top of the hour here, but any closing thoughts, anything else you'd like to wrap up with before we finish for today?
Other than Alex, I think your report is something everyone must read, go decode and decipher. And, there's so many lessons in it. So thank you so much for putting it together and for sharing your insights today.
Thank you.
Yeah. Alex, any final words of wisdom from you?
I don't think so. I think it'll be very interesting to see what 2022 brings, and whether or not 2021 was a huge outlier. I wouldn't be surprised that 5 years from now we put these charts together and maybe it's something of a new normal, or maybe it's just this huge spike in 2021 and things come back to earth, and we're going to be looking at funky charts going forward. So it'll be interesting to see what happens this year.
All right. Well, thanks again to our panelists, Sherry Capel of Litera and Alex Licken of Pitchbook, and to Litera for sponsoring today's webinar, to Pitchbook for contributing the data and analysis, and to Above the Law for hosting it. Thanks to everybody in the audience for participating today. Really appreciate it. As I said, you will be getting a follow-up email that will give you access to the full report we've been talking about. And as Sherry just said, it's a really good read. Urge you to go through it and take a good look at it.
Really.
On behalf of everybody here, this is Bob Ambrogi. Thanks a lot for listening today.